With the average housing cost in the US on the rise, house hacking gives a pretty attractive opportunity to offset living expenses and potentially even profit from cash flow. However, like any investment, house hacking comes with its own set of risks and rewards. Today, we will talk about the risk of waiting to purchase a home, the low risk to house hacking, and how it allows investors to grow their rental portfolio at a much higher rate. So to start this off, we have housing costs. Housing costs in the US have soared in recent years. This ultimately makes home ownership simply just seem unattainable to the average person looking to buy. With that, a stat that I came across recently states that the average monthly housing cost in the United States has reached $1,900 per month. This is a 6% increase from the previous year, where the average housing cost is just under $1,800 per year. So a little over a $100 jump per month. You can't control your rent, but you can control what you want your monthly mortgage payment to look like when you're starting to look for homes. But anyways, so very similar to what we're seeing in today's market, where there are periods of time when the average annual rent increase outpaces the average annual home appreciation rate. While rents are up 6% year over year, right now the average national home appreciation rate per year or year over year is sitting right around 0%, give or take, believe it or not. So from this perspective, you could make a case that there are times like right now, and it is actually more risky to rent and wait to purchase that home than it is to just make that jump and buy that home. In short summary, there is a risk to renting when you are considering the opportunity cost. And one of the key advantages to house hacking is the ability to leverage some of those low down payment options when you decide to purchase a primary residence. Unlike traditional investment financing, where a 20% down payment is pretty normal to see, thank you to the 2008 housing crisis, but house hackers can purchase investment properties with low down payment loans, such as that FHA loan with 3.5% down minimum, or even conventional financing with 5% down. So to put this into perspective, this means that on a $200,000 property, the down payment could be as low as $7,000 with an FHA loan, or $10,000 with a conventional loan. That same $200,000 property with investment financing would require $40,000 with a 20% down payment. So with such a low initial investment, house hacking allows a little bit of margin for trial and error. Smaller down payment not only makes home ownership more accessible, but also from the investor standpoint, provides much lower risk with less of your money strapped into that property. Which brings me to one of the best parts about house hacking, is that it's repeatable. Before we continue on here, an important thing to note when house hacking is that in order to avoid mortgage fraud, you have to live in that property for 12 months minimum before a new owner-occupied loan can be issued in your name. That was not a fun sentence to say. So now that we got that out of the way, having that low down payment on each property even further lowers your risk from an investment standpoint when you decide to repeat this process. By house hacking, you can make your money not only work harder, but also lower your risk when you purchase multiple properties. For example, with that $200,000 property that we mentioned earlier, the $40,000 down payment you would put down with investment financing, a house hacker could purchase 4 $200,000 properties with that same $40,000 spread over 4 years with 5% down each, which in turn lowers the overall risk. If that one property that you purchased with investment financing goes to zero, you've lost 100% of that $40,000 and 100% of that house, obviously. But if one of the 4 houses that you purchased when you were house hacking goes to zero, you only lost 25% of that $40,000 and you still own 3 other properties. So with one property purchased with investment financing, the risk is vertical. You purchase 4 properties with that same money, the risk is horizontal. So to sum this all up, if you want a house hack, or even if you just want to buy that first property, but maybe you're just on the fence if you even want to house hack, buying right now, even where current prices are and even where current rates are, look a heck of a lot better on paper than renting does. If you want to purchase investment properties, but maybe you don't have a whole lot of money to put down on one, house hacking is the best way to do it. It just has a lower overall risk to purchasing investment properties by house hacking. This is both from the standpoints of requiring less money down, and when you decide to repeat this process, it spreads the risk over multiple properties with the same money that you would have spent otherwise on one investment property just by not living in it for a year first. So that about wraps it up. I hope this was helpful. If you found value in this video, please like and subscribe. If you're thinking about purchasing your very first house, maybe considering house hacking, maybe not, give me a shout. I'd be happy to help in any way you see fit. I love my job. My favorite things in the world is to help people purchase either their first home or their second, third, fourth when they're house hacking. Thank you so much, and we will see you guys next time.